Hey, Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I want to touch on the hot button topic this week, which is inflation, obviously running at a 30-year high, coming in at 6.6% year over year. And, proving again not to be transitory. We actually got some updates here that the Stats Canada will be adding in used car prices. So, the US, for example, already has used car prices in their index. That's why inflation in the US is higher than it is in Canada. But we were adding used car prices to our index starting next month. So you'll probably see a year-over-year inflation print of 8% year over year in Canada. So everybody's going to be freaking out. Keep in mind that I strongly believe, and it's not just my opinion, but I think if you look at the data, that we are going to see inflation peak out from a rate of change perspective by the second quarter of this year. So you'll probably see 8% here, and you'll start to see it coming off. Instead of 8% year over year, you might see 6, 5, 4, etc. So that's kind of where we're going. But again, this is getting people talking about, well, oh my gosh, 30-year high in inflation, car prices are going to be coming in, so that's going to be inflation 8% next month. Oh my gosh, we got to raise rates. Of course, we got, the most hawkish of all, banks and economists. We've got Scotiabank, who we've kind of been somewhat making fun of here on the channel for the last couple months, but now calling for a 75 to 100 basis point rate hike increase at the Bank of Canada's next meeting, basically saying they need to do like a shock and awe type of rate hike increase. And so, again, I'm going to sort of provide my own commentary on where Scotia is coming from, because as we've talked about before, so Scotia is calling for like these shock and awe rate hikes. They're calling for the Bank of Canada overnight rate to be at 3% by the end of the year. Now, keep in mind that we're at 1% today, so they're projecting another 200 basis point increase in the overnight rate. However, to the housing bears' chagrin, is that Scotiabank is not predicting any decline in home prices. They're just saying housing activity is going to moderate and home prices are going to remain basically robust, and that's their view. So keep in mind that Scotia, if you were to see national home prices, let's say in 6 to 12 months from now, down 10%, I can guarantee you Scotia would not be calling for a 300 basis point overnight rate by the end of the year. So either Scotiabank, for example, is wrong on their rate hike forecast, or they're wrong on their home price forecast. It could be both. Maybe it's both, but I don't think they're not going to be right on both calls, because, again, I think some of these banks, these economists, they live in these ivory towers. They need to get out there and why not actively talk to people in the industry? Why not, put your shoes on, go walk around the neighborhood and talk to, some real estate professionals that are in the industry. We're already seeing price declines, and we've talked about in this last week's episode. Sales activity, guys, has dropped off rapidly. This is a market that is changing, that has gone from a disco inferno in January and February to somebody just might have just turned the lights out. Sales activity is not good right now. If you look at the suburbs, you just go ahead and run a comparative analysis. I mean, hey, if you want to bug me, I'm happy to send you some comps here, but run an analysis on detached houses or townhouses, particularly in the suburbs, and see what they're selling for back in February to what they're selling today here in the third week of April. I mean, you've got prices off anywhere from 5 to 12% right now. And I'm talking direct comparables. It's not like, hey, that neighbor, you can't really use that comp. I'm talking hey, you've got a cookie cutter townhouse here. There's one in the complex that just sold back in February for $1 million. The same one today is going for $875. Hey, hold on a minute. So the price declines, guys, have already started. And the fact that we're talking about, hey, we need to do this shock and awe, like I said, from a rate of change perspective, inflation is going to begin rolling over. But again, let's watch and see. I know everyone's rooting for some affordability in the housing market, so there's certainly people welcoming a housing price correction. I get it. But I just find this rather ironic because I think we are really setting ourselves up for a financial mishap here, just assuming that households are going to absorb this because we've stress tested everybody. But as we've talked about again, are we really stress testing anyone when little Johnny's got his parents co-signing on the mortgage and he's getting $100,000 gift down payment from grandma? I mean, not really. So I don't think little Johnny's actually prepared for interest rates to go to 5.5%. I think he's buying because he's able to lock in a rate today at 3%. Anyways, but now as we've talked about, rates aren't 3% anymore. I mean, if you're on an old pre-approval, again, keep in mind, guys. You can get a pre-approval from the bank with a rate hold. So they hold your rate no matter where rates go. You get to hold the rate. They hold it for you for 90 days. So a lot of people that are still transacting in today's market are on these old rate holds from a month or two ago. And so a lot of them aren't subjective to the new rates, which is, guess what? The 5-year, the best. I'll give you this. This is You're welcome for the free mortgage tips here, even though I'm not a mortgage broker, but this is my job, basically, is to know what's happening in the real estate housing market. The best 5-year uninsured mortgage today is some obscure monoline lender at 3.79%. Every 5-year, every big bank now is at 4% or higher on a 5-year fixed mortgage. And that's going to actually probably continue to creep higher. We just had the Canada 5-year bond yield shoot up again to 2.85%. So the Canada 5-year bond again is doing all the tightening, and then the Bank of Canada is kind of coming in on top and trying to and squeezing everybody, which is again just the timing of these guys. It's like they always react. They're never proactive. And so, we're seeing all this tightening at the end of the housing market boom here. And so, the 5-year bond yield is now at 2.85. That was up around 0.8 about a year ago. So just a massive move. That's going to push 5-year fixed mortgages probably even higher. You could be seeing 4.5%, assuming this continues in the next, month or so. But let's shift gears to where things get even more complicated, which is variable rate mortgages. So we know that during the pandemic, right? People were scared. The Bank of Canada came out and said, don't worry, guys, we got your back. We're going to pump the money. We're going to pump the financial system full of money, cheap money. We've cut rates to zero. And guess what? We're going to hold them there until the end of 2023. So if you want to go and, spend money on your business and borrow up your eyeballs and go get a big house, go ahead. Great. We've given you the green light to go do that because guess what? We're holding rates to zero to the end of 2023. So what happened is variable rate mortgages dropped down to about as low as actually you could get a variable rate mortgage at 1% through an insured mortgage. But, for all intents and purposes, let's say variable rate mortgages basically bottomed at about 1.1%. So what happened was there was this spread, right? You had a spread between the variable and the fixed rate mortgage, and people say, wow, that variable is so cheap, and the Bank of Canada has told me rates will never go up, so let's go and buy them, and let's go buy a big house on a variable rate mortgage. And so what happened was basically over the past 6 months in particular, the data that we have is 54% of all new mortgages that were issued for new purchasers, 54% of them opted to go with a variable rate mortgage. That's more than double the long-term average. Since 2013, variable rate mortgages have only made up about 25% of new mortgage issuance. So you had all these people that basically got lured in through these low interest rates. And now we're obviously raising rates, and hey, Scotia says we're going to get to 3% on the overnight rate. That would bring your variable rate to, 4.5%, something along those lines. So let's watch and see, because what's important to sort of interpret this, guys, is that most banks now, any of the big Canadian banks, so there's 5 of them, right? The only one that's Scotia, ironically. 4 of the 5 have fixed payment variables, which means the Bank of Canada can raise rates 200 basis points and your payment won't stay the same. You'll pay less on your principal, you pay more towards your interest, but your payment will stay the same. So at least you got the security knowing that your payment's going to stay the same. Well, what happens now is that there's a trigger clause in all of these fixed payment variable mortgages. There's a trigger clause, aka there reaches a point where you basically become negative amortizing on that mortgage. So they have to then readjust your payment structure, aka increase your payments. And I can tell you what it is because I actually went and looked through my own mortgage contract personally. So I took out a variable rate mortgage at 1.2%. And the trigger in that clause is 4.5. So they say if it gets to 4.5, so right now I got it at 1.2. Right now it's at 1.95, I believe now, after these recent rate hike increases. So if it gets to 4.5, then it triggers higher payments. So you're gonna you could run into a situation again, hypothetically. See if Scotia's right. You will trigger a lot of these variable rate mortgages, which again just blows everything up. So that's kind of my interpretation of things. Is like, listen, let's try to understand that housing is 25% of GDP. I mean, not to mention all the knock-on effects and consumer spending from the wealth effect of house prices, et cetera, et cetera. And so if housing starts to slow down and prices start to decline, at what point do we stop talking about inflation and we start talking about, okay, inflation's rolling over, now we've got a financial stability problem? Because as I've talked about, we are seeing sales activity drop off. They're not moderating like these economists are talking about, or the Bank of Canada is talking about, moderation housing, it's all going to be, we're going to stick the landing here, guys. And this is not a moderation. This has gone from disco inferno to lights out. And anyone that's been watching this channel will know that I told you 12 months ago, I said, watch, if mortgage rates get to 3.5% and they hold, housing activity will fall off a cliff. Why? All you have to do is go back again to 2018. We saw the same playbook in 2018. Home sales cratered to nearly 2-decade lows in parts of Canada because mortgage rates hit 3.6%. You tack on more debt today, higher house prices, and all of a sudden, hey, housing becomes almost uninvestable with rates at 4.5%. It is what it is. And so that's kind of where we're going to wait and see how this all plays out. You guys certainly know my views. I think that we are setting ourselves up. I almost think the Bank of Canada, to be honest, I think if you want to how do you kill inflation? Well, I mean, really a lot of this is supply chain problems. So the only way that they can maybe kill inflation is by shooting demand in the head, aka let's engineer a recession and let's kill the consumer. So I don't know if they're that sort of twisted to do that, but that seems to be the game plan right now. So very interested in watching how this all shapes up. And, again, hopefully that helps you sort of interpret things, what's happening in the housing market. Again, very low inventory today, which is sort of helping things at least, but we are still seeing prices declining already. And like I said, sales activity has come to a screeching halt. So as always, let's watch and see, and we'll see you next week.